Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's discussion will largely encompass the dollar-yen market. The dollar-yen market struck off yesterday's U.S. new home sale print and retraced most of its losses in anticipation of today's Japanese CPI report, which will provide clarity on how the BOJ will approach its open-ended stimulus program, which the market had been anticipating and pricing in since the beginning of the year. I hope that this commentary will prove to be insightful in formulating a successful trading strategy for you. First, in line with this commentary, we will touch base on the dollar-yen market on a technical front. The dollar-yen market opened today's Sydney trading session, struggling off yesterday disappointing U.S. new home sale and retraced almost all of its losses incurred during yesterday's trading session. Strong bullish momentum continued to remain largely intact on the dollar-yen cross when the pair failed to break below the 200-day simple moving average during yesterday's trading session. This viewpoint is also supported by retail traders with their net open long positions on the dollar-yen spiking at 2.5 outstanding long position for every one short greenback position hedged against the Japanese yen. With reference to the SSI, which is also known as the Speculative Sentiment Index, currently net retail traders continue to buy into every consolidation opportunity presented in the dollar-yen market. Thus, analysts would suggest taking a contrarian view to this crowd sentiment and expect the cross to test lower lows moving forward. In line with this concept, analysts are also calling for further weakness until the cross can close and sustain momentum above the critical 103 level. Analysis of a collection of technical indicators on the hourly interval on the dollar-yen market suggests a temporary bullish market sentiment and recommend short positions on the Japanese yen. The hourly chart showed that the dollar-yen opened today's Sydney trading session inching closer to its established short-term Fibonacci support at 102.44, while the Fibonacci resistance is set at 102.64. Ever since the pair broke out above the 200-day simple moving average during last week's trading session, bullish momentum continued to hold. What this entails is that the long-term outlook on the dollar-yen cross has been upgraded if the trend line continued to trade above the 200 days. This trend holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data and the forecast long-term market sentiment. The bullish long-term outlook on the dollar-yen pair is also shared by its short-term moving average counterparts, as the dollar-yen opened today's Sydney trading session above the 5, 10, 20, and 30-day short-term moving average. Collectively, this is very indicative of a buy recommendation on the technical front. So let's have a look at the volatility index. VIX is a great measure of the level of fear in the marketplace, and since fear has been and has a negative effect on the risk appetite, we always use fear to gauge the direction of the dollar-yen market. Since February, the level of fear has leveled off significantly, and this is very indicative of that risk appetite continue to remain intact, thus supporting the dollar-yen pair moving forward. Moving along to the fundamental front on the dollar-yen market, the dollar-yen market began this week's trading session rallying from the 102.40 level to the 102.6 level on a disappointing Japanese trade report. The report was released on Sunday and it entailed a slowdown in Japanese export market coupled with the jump in import number. Japanese trade deficit rose to 1.71 trillion yen when forecasts expected to read at 1.27 trillion yen in deficit, while export print year-on-year expanded at its lowest pace at 1.8% when forecasts were set at 6.3%. However, import year-on-year rose 18.1% when the market consensus only expect a 16.2% rise. This collection of data play an important role in determining growth forecasts for Japan, as this island nation is heavily reliant on its export industry. Today's risk event will expose the dollar-yen market to some degree of volatility as the market anticipates the release of Japanese national core CPI year-on-year print expected to take at 1.4%. Ever since the Japanese VAT tax hike was implemented at the beginning of April, the government expects the CPI print to come in weaker than market expectation, while the BOJ on the other end of the spectrum is optimistic that the Japanese consumer has spare capacity to shrug off the implication of the tax hike. In the case the inflation number failed to meet expectation, this would only prompt speculation that the BOJ would cave into market expectation for a more aggressive easing policy by continuing its open-ended stimulus program. However, if CPI reading came in line with expectation, then the market will expect the BOJ to maintain the continuity of its current policy into the second quarter of this year. With this in mind, against the backdrop of the Federal Reserve unwillingly to step away from a 0% interest rate doctrine, this will only set condition for a medium to long-term congestive trading range for the dollar-yen market until a shift in fundamental outlook has materialized. On the other end of this fundamental component, which hold great influence over the dollar-yen market, is the sustainability of market risk appetite. Risk appetite continued to remain intact in the marketplace, and this idea was validated during the release of yesterday Chinese HSBC manufacturing PMI number. Once again, failed to meet expectation by coming in at 48.3 when market anticipated to read at 48.4. A PMI reading below 50 price value implied contraction in factory activities. However, the market shrugged off this news until the release of U.S. new home sale disappointingly missed expectation by coming in at 380K when forecasts expected to read at 450K for the month of March. The release of Chinese PMI number had very little effect on the Nikkei 225 Japanese equity index, and since the dollar-yen is highly correlated to this particular equity index, the resilience of its performance is very indicative that risk appetite in the marketplace continued to remain largely intact. As of recently, the world's largest pension fund, also known as the Japanese Government Pension Investment Fund, openly revealed to the market that it will increase its investment exposure to the domestic equity market, chasing yield. This plan of action reaffirmed that risk trade is the best plan of action in an era of low interest rate. Across the Pacific in the United States, the market is anticipating today's initial jobless claim number expected to take at 310K, while core durable goods order month-on-month is anticipated to expand at 0.6%. I want to thank all of our listeners for spending the time with us. Until then, have a successful trading day, everybody.